Greetings and welcome to a journey of financial wisdom. Today, we tackle the topic on everyone's mind, the recession. With focus on the crucial 10 things to steer clear of investing in during these tumultuous times. Before we begin, please take a moment to sit back and make yourself comfortable. Once you are ready, please subscribe to our content, so that you don't miss out on any future updates or information. 1. Individual stocks of struggling companies. Let's face it, during a recession, not all companies are created equal. Some will survive, but others will sink like a stone. This is because struggling companies are more likely to go bankrupt during a recession, which increases the risk of losing your investment. Also, recessions are usually characterized by increased market volatility, which can lead to significant declines in the value of stocks. 2. High-yield bonds from companies with weak credit. During a recession, the ocean of the financial market can be rough and unpredictable. Companies with weak credit are like that dangerous pirate ship, signaling to investors that there's a high risk of sinking. If you invest in their bonds, you're essentially taking a leap of faith, hoping that the ship will stay afloat and bring you the treasure of a high yield. 3. Non-diversified mutual funds. Investing in non-diversified mutual funds during a recession is a lot like choosing the single-wheeled motorcycle. These mutual funds invest in a small number of securities, putting all your eggs in one basket and relying on the performance of a limited number of companies to carry you to your investment goals. 4. Luxury real estate or high-end collectibles. During a recession, the financial landscape is unpredictable and can be full of obstacles, much like a stormy sea. People may experience a reduction in income and wealth, making luxury investments less affordable and reducing demand. Additionally, consumers may cut back on spending, which can reduce the value of high-end collectibles. Furthermore, luxury real estate and high-end collectibles are often considered illiquid investments, meaning that if you need cash, you may have difficulty quickly selling them for the money you need. 5. Cryptocurrencies with no clear use case or backing. Without a clear understanding of the underlying technology or purpose of the cryptocurrency, you're taking a blind bet on its future value. During a recession, the financial landscape is already uncertain, making it even harder to predict the future value of speculative investments like cryptocurrencies without a clear use case or backing. The cryptocurrency market is also known for its high volatility, making it a risky and unpredictable place to park your money during an economic downturn. 6. Startup companies with unproven business models. Investing in a startup can be risky at the best of times, but during a recession, it's even more so. With the economy in turmoil, it's difficult for new businesses to gain traction, let alone survive. Here's why. Startup companies with unproven business models often have limited resources, making it difficult for them to pivot or adjust their strategies in response to changing market conditions. This leaves them vulnerable to economic uncertainties and market forces, which can erode their value and impact their ability to succeed. 7. Overpriced or saturated markets. In a recession, investors tend to flee from high-priced assets in search of safety. So, if you're considering investing in tech stocks, be aware that they may not perform as well as you hope. When a market is overpriced, it's only a matter of time before it corrects itself, potentially leading to significant losses for investors. Also, the tech sector is often a crowded space, with many players vying for a piece of the pie. This saturation can make it difficult for companies to differentiate themselves and perform well, especially during a recession when the economy is facing challenges. 8. Physical retail store in declining industries. During a recession, consumers tend to spend less, which can be bad news for physical retail stores in declining industries. So, think twice before investing in a struggling brick-and-mortar business. 9. Commodities with low demand and high volatility. The prices of commodities with low demand and high volatility can change rapidly, especially during a recession. Commodities like oil are driven by supply and demand. In a recession, economic activity slows down, leading to a decrease in demand for many goods and services, including oil. This decrease in demand can lead to a sharp drop in oil prices, putting pressure on companies in the sector and potentially wiping out any gains for investors. 10. Mutual funds with high fees and poor track records. In a recession, when markets are already underperforming, the impact of high fees is even more pronounced. Instead of having more money to reinvest or save, you'll have less due to the high fees. Also, you want your investments to perform well and generate the returns you need to meet your financial goals, but if a mutual fund has a losing streak, it's unlikely to be well positioned to weather the challenges of a recession. And there you have it, the 10 things you should avoid investing in during a recession. Remember, during these uncertain times, it's more important than ever to be mindful of where you put your money. Do your research, understand the risks, and always consult a financial advisor before making any big investment decisions. Thank you for watching. If you like this video, be sure to give us a thumbs up, leave a comment, and subscribe to our channel for more great content. We'll see you in the next one.